Good evening, everyone. You're all very welcome to this week's weekly market webinar, focusing on all the key themes and events into obviously tonight's call, looking at the price action over the last week following last week's closure, and of course pending volatility obviously today and for the rest of the week going forward. I suppose today has been quite an inflection point for a lot of markets. The instability within the French government leading to the potential for a collapse in the French government under the leadership of President Macron has spooked some of those markets today, this afternoon, into the European close at 4:30. We've seen a fairly significant deterioration in risk appetite for those risk-orientated assets. And of course, we have seen the volatility curve steepen by 2-3% through the course of the session. Now, we had seen an inflection point in gold. We did see a correction, but gold is still holding a lot of its kind of medium-term headwinds. Now, today, as I said, we've seen the crypto assets get quite heavily hit. We also saw quite a significant move in global indices. So whether it's the US 30, whether it's the NASDAQ, or whether it's the S&Ps, quite a decent bit of selling coming through in the US session today, as I said, into that 4:30 US close. But quite surprisingly, we didn't see much of a movement in the DAX. We didn't see much of a movement in the UK 100, the FTSE 100, with the CAC obviously being slightly off. What does that mean for broader markets? Well, obviously, when we look at the risk-denominated profiles, equity markets are a little bit kind of turbulent. Very, very interesting to see what happens with the European equities as we move into tomorrow's trading session for Wednesday, to see if there's any sort of ramifications based on what we've seen obviously in France today on the political side of things. And of course, really to see, do we get more risk aversion as we move into tomorrow's US Open in a lot of these assets, so the likes of the indices, but also in the likes of the crypto space, which has been very, very bullish over the last week and a half, but we have got a fairly significant inflection point today with BTC, Ethereum, XRP, Solana, some of your main ones down kind of 3-4% on the session. So there's been fairly significant movements today. In the back foot as well, as we said today, into the open, we saw the VIX pick up, but really around about 3:30 into the London under close at 4:30 and the European close at 4:30, we did see that VIX move aggressively from that 1650 level up into that 1750 level in terms of that. But it'll be interesting to see whether that VIX volatility curve actually, as I said, continues to steepen as we move into US Open tomorrow, London Open tomorrow morning, and then obviously progressively into the US session. And really seeing if there's any sort of inflection point in risk profiles. But I think broadly speaking, the markets has been incredibly bullish over the last kind of 5 weeks or so. This is obviously the September lows, which is something we've kind of focused quite a lot on. Even over the last week or so, really from Wednesday 1st, we've seen a further leg up and a consistent movements Wednesday, Thursday, Friday, and even Monday this week with markets actually pre-markets today hitting all-time highs on the S&Ps before that market kind of shifted and retraced. So broadly speaking, yes, we've seen markets move lower on the session as we move into US close tonight. But again, that's kind of what you'd expect. Very, very healthy corrections off of short-term fundamental events in the face of what's been a very, very strong risk-orientated trend, as I said, not just into September and early October, but more progressively really since those early mid-April cycle lows. And of course, we've seen how progressive the stock markets have been since then. So really tonight, it's all about being tentative. We know obviously as we move across the shores into the US, government shutdown is still in play. Still no signs of any sort of accommodation yet. Executive orders has moved to the special branch, which takes a lot of the kind of the power away from the Democrats. So it'll be very, very interesting. But there's been a lot of political nuances, political battles back and forth. Republicans blaming Democrats, Democrats blaming Republicans. So it'll be very, very interesting to see. So obviously with the shutdown, it means no reporting of data. So obviously last Friday's NFP was cancelled. CPI data, which is due on Thursday, will most likely be cancelled as well, with the jobless claims also being cancelled. So really the focal point is with the pending shutdown and this ongoing shutdown, it really kind of opens up the avenue for the Fed to be more bearish or more dovish, in the sense that they have to obviously safeguard markets. Price stability is obviously a fundamental core ethos within their kind of within their, I suppose, mandate and I suppose their model. So of course, with that being said, it actually allows for these markets to kind of grind higher, and that's effectively what we've seen since last week. So if you look at Wednesday, Thursday, Friday, we just saw that successive grind, pull back, grind higher, pull back, grind higher, and it's only today on a short-term fundamental piece that we get any sort of medium correction. But even at that, from the highs of where we were today, the S&P's is only down 40 points, which is actually under 1%. And even when we look at the stock market performance from the open to where we're currently at, S&P's down at 0.4% on futures, Dow Jones at 0.3%, and the NASDAQ just down at 0.5%. You'd actually say, relative to the fundamentals and kind of the disruption that we're seeing in Europe, markets are actually still holding up very, very well. So just be mindful of that. I think we obviously have to be quite tentative this week. This week's really been more about, obviously, central bank speakers and the wires. So this is really going to be we've got the next Fed meeting is going to be, I think, on the 18th and 19th of October. So this is really going to be the last week where a lot of speakers are going to be on the wires. And then, of course, we have our 2-week blackout where there'll be no comments, there'll be no kind of opinion pieces, there'll be no kind of speeches from any of the Fed speakers until they meet in October later this month for the next meeting. And of course, we're pretty much expecting 25 basis points to follow September's rate cut, increasing those rates lower, with the expectation of could we actually see another 25 basis points in December, and that is becoming the realistic case now. So 3 successive 25 basis points in the face of grinding higher stock markets in the midst of the shutdown shows that even though there is obviously negative nuances associated to a government shutdown, it probably opens up the Fed's mandate for being a little bit more protectionist of the economy and of stable markets and obviously the prices. And obviously, of course, the NFP data from last Friday, which we don't obviously have. So markets is tentative. Naturally, as traders, we have to be cautious of that, particularly on the downside. So if there's any sort of negative news or any sort of fundamentals, like, for example, what we saw this afternoon and today with regard to France. But overall, you'd actually have to say markets is taking the shutdown progressively quite well. And of course, we have to still look at that in the broader sense of things. So really, for markets to shift and pivot into a deeper correction off of kind of what would be foreseen to be negative or negative nuances, you're really looking for that VIX curve to continue steepening higher. And of course, even since last Wednesday, from when we kind of got that shutdown, the VIX is only marginally higher. Now, albeit we have seen a fairly significant move in the dollar over the last week or so. Really, from last Thursday, we had that move into 98. We had that gap higher on Monday, which hasn't been filled. And we've kind of seen that steady increase in the DXY over the last few days. So we talked about it in recent weeks that the DXY moving higher wouldn't be a surprise. If it's a case that we saw more rate cuts coming in October and December. And that really starts to become a fairly common theme now, that we saw it in 2024 when the Fed was increasing rates, the dollar actually strengthened rather than actually weakening. And from the September FOMC meeting, that has actually confirmed the bottom, at least into the next, or what would probably be into the next FOMC. Now, obviously, a lot can happen over the next week or two, but overall, we're seeing the DXY at October highs. We're seeing it actually challenge the Thursday 25th highs, and really at the same price that we saw towards the end of August, beginning of September. So this 98.50, we broke above 98, we've sustained above 98, we've progressed higher into 98.50, heading for 98.60 tonight. It's really a case of, is this the inflection point in the bottom? Are we going to get that one further drive lower in the DXY? Well, at this moment in time, very unclear that that's actually going to happen. And if so, well, then you'd actually be looking for the DXY to really try and systematically break into that 99, take out the 99, and try and push into those midsummer highs of July, where you're heading into that 101 threshold level up here. So at this moment in time, the inflection point in the euro dollar is very, very interesting. The inflection point in the GBPUSD, the cable, very, very interesting. We talked about it last week, looking for those pullbacks into that 135, 135.20. In fact, if you look at the price action over the last week, we had that rejection. Then we had that lower high, we had that systematic breakdown, we had that retrace in the Friday, we had the gap close on cable. Now we didn't get the gap close in the DXY itself on the index, but we did get it on cable. And since then we have actually seen those markets drift lower. So if we're taking out that 134, 134.25 handle, if we're taking out that 116.50 handle, which is coming under a lot of pressure, there's nothing stopping this euro dollar price, this cable price, entrenching more lows or more downside pressure, particularly, as I said, if this DXY can try and take out some of these short-term highs that we've seen on the 4 hour, on the 1 hour, over the last, as I said, kind of 6-8 weeks, systematically above 98.50, but more closely into that 99 handle. So keep an eye on that one. Short-term headwinds are very much there, but as I said, if that 16.50 gives way short-term, quite interesting. You can even see it tonight into the close. Markets is selling off. We're retesting those September lows from the 25th. Very, very possible that we see markets entrenched to the downside. And as I said, same thing with cable. It systematically did make lows this morning. It got back into the value area around that 34.40 and has already symbolized more lows as well. So really setting forth the narrative for cable prices to extend lower. And when you look at the higher time frame perspective, cable prices had a massive run up from the early year lows. We went from 120, 122 into 138 cycle highs, at least short-term cycle highs, followed by lower high retest. We've created lower highs, should I say, at the end of September. And on the internal structure that we've talked about on the 4 hour, if we start to see pressure coming into tonight's close below that 134 handle, we could now be looking for price action, incrementally trying to make new lows into the 133s, into the 132s, and become more corrective for that DXY to progressively move higher. So keep an eye on the DXY over the next kind of 1 to 2 days. I think it's going to be very interesting into Thursday. Obviously, the calendars this week has become a little bit more distorted because we have a lot of central bank speakers. We obviously haven't much due to the shutdown, but we do have Fed Powell speaking on Thursday afternoon. And those types of comments may pivot. If he starts talking about further cuts in October, which we're expecting it to happen, further cuts in December, with the way the dollar has pivoted off of central bank actions, well then that could actually be a narrative for that DXY to cycle through that 98.80 into 99 and progressively to the upside. So just because the Fed's cutting rates, we could see an actual buy everything rally. We could see dollar treasuries been taken on in money markets. We could still see the S&Ps, the NAS and the Dow cyclically continue to move higher into Q4. Doesn't necessarily mean that we can't. But as I said, let's just keep an eye in terms of the risk profiles for any sort of corrections, those 2 to 3% corrections that we've seen quite a bit over the last 6-8 weeks. Every time we've seen a kind of a 2 to 3% correction, like for example, into the 25th, we got a correction, markets went higher again. If you go back into the August, end of August, beginning of September sell-off, very, very clear sell-off, markets springboarded this gigantic move in US assets. So just be kind of mindful of that corrections in these markets are healthy as long as they prove to be temporary. If the lingering effects starts to pivot, well then that might be a rotational play to maybe take short-term profits, particularly if you're, let's say, medium or longer term investor, asset manager, or anything like that. But from a short-term perspective, it has proven to be a year where we buy the dip. So at this moment in time, it's creating those impetuses for the next dip. Now, when we look at the likes of the S&Ps, when we look at the likes of the NAS, when we look at the likes of the Dow, they are at kind of at least short-term structural levels, right? Because if when you fade it out, all three, as I said, are creating systematic higher highs. So take, for example, Dow Jones. We had that kind of systematic breakout. We had that period of consolidation. We went into a phase of structural increasing price volume to the upside, right? Didn't matter the narrative. We had the buyout, we had the pullbacks, we had the buyouts, we had the pullbacks, we had those trend continuation structures. And today, and over the last few weeks, we've seen that continue to create impetus. So, for example, last Wednesday, we got the breakout into Thursday. We continued progressing higher into Friday's highs. We got the truck and trailer like formation where we get that corrective move, that 2 to 3 day corrective move back to that broken level. So for me, this week, worth watching closely this 46.4, 46.5 handle. It's proved to be a bottom yesterday, Monday. It's proved to be a bottom today with buyers coming back in off of those levels. And if that is proven to be the bottom, then you'd actually like to see price action structurally try and get back above today's value area. but ultimately try and go back into the highs of today's session, which is up around that 46.9, and then that could become the next tranche or next potential move higher. So keep an eye on this yellow area. That's really what I'm looking for this week. If we were to be more aggressive on the higher time frame and extend lower, a break of 46.5, 46.4 probably extends at least 200 to 300 points lower back into this midpoint range. Now, the reason why I'm saying this midpoint range is because if you zoom out and you look at the price volume really from the middle of September into the early parts or end of September, early parts of October, a lot of volume here on Wall Street between that 46.1, 46.2 handle. So if we were to break through here, you'd actually probably expect it to go a little bit lower and look at that being a potential area of interest for lows. And you can even see it as well if you were to look at the October beginning bottom for buying, it came in around that 46.1, 46.2. So keep an eye on that tomorrow, being nimble but being cautious that if we were to break through, the likelihood is you could actually try and take out this wick and go back into this volume area down here. So that's really your breaker bounce on Dow. When we look at the NAS, quite a similar type of scenario. NASDAQ obviously hugely bullish over the last few weeks. Obviously we had that breakout, we had that retest in September, we've talked about it. We got those cyclical breakout and retraces, the apexes that we talk about into month end or the latter end of September, quite progressive. And then of course last Wednesday we got that breakout, confirmed, we got the retest, we got the double tap. We'll keep making all-time highs. So if you look at price action over the last few days, it's quite interesting. Breakout, retest, new high. Continuation, new high, retest, new high again, followed by retest. So this area in yellow, like with the Dow Jones at 46.5, that 24.8, 24.9 is going to be pivotal into, let's say, Thursday into Friday to see if that actually does hold up. If it, let's say, on the off chance we see more bearishness, we see the VIX continue to pick up, we see more kind of risk aversion in the risk or traditional risk denominated assets, you would actually expect these markets to move cyclically lower, right? So that's really taking out this yellow area and really springboarding a move back into some of these lower bounds. So you've got obviously the 26th of September lows around the 24.4, 24.5, and you've also got that 24.6 handle as a potential impetus. So that you're really kind of talking 200 to 300 point pullback. Now again, in relative terms, you're only talking marginally over 1.5%. So when we look for corrections, this is why we've kind of been saying 2 to 3% has been kind of the standard. You were to look at that as a corrective, you're kind of talking 2 to 3%, and you'll see that for yourself, kind of 2.5%. If we were to see a similar type of scenario, even from here, if there was a little bit of short-term bearishness, again, 2 to 3%. So you're kind of seeing a lot of those kind of 2 to 3% corrective movements before buying kicks back in again. So if you're catching a trend, I would say best case scenario is, again, within your own research, try and find those retracements. Try and find those pullbacks rather than trying to be too over-eager, trying to be too kind of steadfast. And I often say a little bit of extra patience goes a long way. But even tonight, as I said, we are still holding above that yellow area. So tonight, very, very interesting to see what happens into tomorrow's open, both London and obviously traditionally with the US as well at 2:30. Now, systematically, again, like with the other two, S&P is very, very similar scenario, right? So we broke higher last week. We systematically went higher Thursday, followed by retest. We then went higher Friday, followed by pullback. And then it was a period of consolidation with marginal pre-market highs today before ultimately price action came back on itself. But again, systematically held above that breakout at 6,700. So you've got 6,700 on the S&Ps. You've got this 24.8, 24.9 on the NAS. And of course, you've got this 46.5 approximate region on the Dow Jones. And I think those are three pivotal levels to really watch out for this week. If all three were to break, you'd probably expect, as I said, a little bit more bearishness, and you're really going back into those early October buying opportunities. So that's S&P's at 66.50. As I said, the NASDAQ down around 24.5, 24.6 potentially, and the Dow Jones probably down to around 46.1. If it went really wicky, you might get 46. But I think this area here, 46.1, 46.2 is probably more likely. But again, it's contingent on risk profile. It's contingent on the volume that we're seeing in the ladders as well. So it's definitely something to keep an eye out on. So overall, you'd actually have to say on the higher time frame, equity markets still resilient, still doing very well. Yes, there has been a correction today, but it doesn't necessarily mean that we're going to get more selling just yet. So we're looking to see, do these lows, do these bottoms, at least today, actually structurally break down to create more downside. But we know that the levels have to be broken for that to actually maintain. And of course, when you're talking about levels being broken, as I said, focusing on the ladders, focusing on the volume within the volume. Okay, so just keep an eye on that one over the next few days. As I said, with euro dollar, systematically and structurally, that 116.50 handle, and we're sitting on it as we speak, could very easily move lower. And if we do break out 16.50, the bottom of this August September consolidations around about 115.75, would definitely look at that being tested, with the viewpoint of potentially actually moving to those August lows, and those August lows is down around the 114.50 handle, potentially as low as 114, depending on how aggressive the dollar bullishness is. But so far, dollar bullishness is kicking on into tonight's close. We've seen it quite aggressive over the last couple of days or so. The gap higher, now again, gap higher didn't fill on the DXY, but it did fill on cable. Okay, and it just obviously depends on the asset that you're trading. So cable is on the back foot. Look for that to extend lower if that DXY continues to strengthen over the next 24, 48, 72 hours. Same again with the euro dollar. Okay, now moving into gold. Gold has just been completely, it just does not care. Hugely bullish moves. Now I think again with gold, we're getting those volatility moves. Like, so for example, last Tuesday month end, we had that aggressive up and down. We talked about it on Wednesday. We talked about it on Thursday. We talked about it more progressively on Thursday. Then, of course, on Thursday, we got that deepening sell-off. But again, it's really creating is a short-term corrective movement. And then what happened? Into Friday, back into those all-time highs, back into 3,900. We've broken out of 3,900, that little bit of a breakout region there. Short-term retest, you can actually even say that the retest in itself was quite tame before price action continued to move higher Friday into Monday. And then, of course, even today again, corrective move this morning. Got back into new all-time highs again, just underneath 4,000, and is becoming a little bit more choppy up around 4,000. So inflection point, fairly prominent key level, 4,000. And of course, really that sets the standard of where or how bullish are we looking at gold. If you were to look at some analysts, I think over the next year or two, a lot of people are expecting to go 5,000-6,000. If you're looking at gold or silver, seeing the appreciation of 40-50%, 30-40-50% year to date in terms of performance, you're probably looking to add on pullbacks, and that again you're looking at 3-5% if you can get it. But at this moment in time, the gold price is not creating 3 or 5% corrections, because you only have to look at the weekly chart, and from that break at 3,400 we have seen a fairly aggressive move in gold pricing over the last, as I said, 6-7 weeks. That breakout initially, and it's been green week after green week after green week without a retest. So it just shows how much exuberance and optimism we have seen in this gold market at the minute, where it went from 3,300 out of the consolidation up to 4,000 in just a number of weeks. So again, gold price has been taken on very aggressively over the last year or two, particularly from that longer term consolidation that we saw through 2023, 2022, basically 2021 to 2024. And since then, it's just been one-way traffic without much of any sort of let up, retrace, or any sort of relief rally to the downside. So gold at this moment is nicely poised just under 4,000. It's really a case of, do we see above 4,000 this week? Do we maybe get a correction short term? I think a nice little apex would be back into this area of interest here. So this kind of prior 3,900 would be a nice opportunity. Buying opportunities ideally would have been in this volume area on any sort of pullback. But even at that, are we going to go from 4,000 down into 38, 3,900? It's who knows at this moment in time, because of how exuberant the buying impetus has been in gold as we move, as I said, into Q4. So where does that leave us then overall? Well, it leaves us DXY picking up, which is putting a lot of pressure on the likes of the euro, on the likes of the yen, on the likes of the pound. So that is obviously going to be something to continue to worth watching as we move progressively into October. And as well, that's just even from an FX hedging perspective. Risk denominated assets, very interesting. Still continue to gain all-time highs, but as I said, not without the 2-3% corrective moves. So as I said, if you're looking to buy on a dip, the 2-3% has held up quite significantly over the last kind of 2-3 months. So as I said, the 2 to 3% as a pullback area becomes a nice potential mandate. Now again, not without its guarantees. It's, as ever, nothing is guaranteed in trading, but those become interesting levels to look out for if those actually do occur. And as I said, same with the NASDAQ, same with the Dow, systematically very, very similar type of structure. Cable prices, as we move into the DAX, we saw that massive exuberance last week. We talked about that kind of break above 23,750, which was really taking out these short-term highs. We got the break, we got the pullback, we saw massive buying, and we talked about it last week. Wednesday, huge exuberance in both the FTSE and of course the German DAX and European equities more broadly. Breakout, retest, and since then it's just been one-way traffic creating short-term highs, pullbacks, short-term highs, pullbacks. Hi guys, I'm back. Apologies, my internet just temporarily just dropped there. So again, continuing on the conversation there from a moment ago, we've seen obviously the European equities stumble this afternoon, but we've actually seen them go back into those consolidation zones. So it'll be interesting to see if there is further selling pressure tomorrow as we move into the London Open, and more progressively as we move through the European trading session into European trading close tomorrow. If there's more political instability, you might actually see European assets try and hedge out some of that risk, which means the progressive movements that we saw in European assets over the last week could potentially start to come undone, where we might actually get systematic corrections. Now, when you look at the DAX in particular over the last few weeks, it has had a very consolidationary up and down couple of months, has come back into that structural focal point. So that structural focal point is really that 24.5 into 24.800 level, of which was created last Thursday on the DAX. Since then, we've seen the DAX in holding patterns. So keep an eye out on risk aversion tomorrow. Now, the only other thing I would also say on the DAX is, yes, we've had a very steepening run up to begin the first week or so of the month, but systematically we have seen downside pressure come in today. So we're seeing structural short-term lower highs in the German DAX, followed by that kind of V-shape kind of inverted move today back into that value area. So for me, systematically tomorrow, I think if we start to see that DAX breaking through that 24,300 handle, I would not be surprised if we actually saw kind of like what we saw today in the US session, where we see straight line selling opportunities. So do keep an eye on that on the London European Open tomorrow for breaks through the likes of the 24,300 handle on the DAX. Now, FTSE, on the other hand, has been quite consolidationary over the last couple of days. It too has been very, very aggressive. Now, the FTSE itself, when you look at the index as an overall whole, you have to see that with the commodity-based stocks within the FTSE 100 index, it has seen some significant headwinds despite maybe what would be thought out of as cyclical rotations. So what we mean by cyclical rotations is when the markets has been so corrective, like what we've seen in the DAX, is there that potential for cyclical rotation out of European assets back into the likes of the US, which was underwhelming and underperforming in H1 of 2025. But overall, you actually have to say is that with all of the commodity-based stocks, with commodity prices ticking higher, gold, silver, mining stocks, even oil, despite oil being on a little bit more of a back foot over the last week or so, you actually have to say overall the minerals element of the FTSE 100 index has actually helped to prop it up. Now with financials and obviously higher interest rates, that has obviously helped UK related banks. And I think that is going to be a fairly interesting narrative to see into year end. And do we see the FTSE kind of continually grind and chug higher like what we've seen with the S&Ps, the NAS and the Dow? Or do we actually start to see a little bit more profit taking coming into, let's say, November, December time and creating potential apexes, corrections and cyclical rotations? So at this moment in time, the FTSE is tied around that 9,500 handle, kind of like the Dow or kind of like the German DAX. Interesting to see if there's selling opportunities coming through. Under 24.3, look for a potential revision. For me, I think you'd really want to be taking out the 94s, 94.50 at least, to create that cyclical rotation. But given how aggressive the buying has been really since the 1st of October, just be mindful that the FTSE is probably going to outperform the German DAX because of the compositions of the stocks that's contained within that index. So just be kind of mindful of that. Now, as I said, moving out of the stock or the traditional stock markets, moving back into cryptos, we have seen a very, very aggressive kind of 6, 7, 8 days in the crypto markets. BTC from the October really beginning emerged from 108 into what was 126 as of yesterday into today. We have seen a cyclical rotation today, low 120s. And really from there, it's interesting to see how far does this progressively go, because of course, when you look at BTC, it obviously is very, very corrective. It's very, very reactionary. There's a higher risk implied volatility curve, which means the upsides will outperform. But when we get those corrections, the downsides will also outperform. So as we look at the S&Ps, the NASDAQ, the Dow today being down, let's say 0.5%, we are seeing the crypto side of things being down 3 to 4%, and you only have to look at Bitcoin today as things stand being down around 3.75 as we move into tonight's close. So we're seeing that corrective movement across the board. So that is obviously something that we have to look out for. I think BTC is very interesting. I think that 120 handle psychologically is going to be quite interesting. If we break underneath 120, systematically you're probably looking at more bearishness, at least more short-term price action, which you're bringing into that kind of 116, 118 handle. If you're to look at Ethereum, well, you've actually got kind of an inverted head and shoulders. So systematically, anything below kind of 44, 44.50 probably brings in 42.50, 43. There's a lot of potential price action structure imbalance in price that could potentially get filled if we were to see even more selling pressure, let's say tomorrow and into Thursday. But short term, at least into tonight, a lot of that selling that we saw through early parts of today has at least subsided in around that 4,500. But it's a case of, do we actually know? We had that very clear break, Solana above that kind of 215 handle into 230, 235. And of course, today we've seen it kind of correct again back into that 220 handle. So for me at the minute, be mindful that if you are day trading cryptos, or you're even looking at DCA, looking for instances where it creates a 5 to 10% correction is your best ally, rather than trying to chase at a new high. Particularly, let's say if you're looking at seasonality factors, or looking at maybe more progressiveness into November, December, or January in the crypto space, then these are the types of rallies that a lot of investors and traders should probably be licking their lips at. So at this moment in time, markets overall is quite tentative naturally because of the shutdown, because of some of the political instability in Europe, but overall still holding up residually fairly well. So the next couple of days is really going to be geared towards volatility. It's going to be given towards the order book and the ladders, seeing the actual volume come through, which I think is through the depth of markets, I think is quite important. And then of course really to see, is there a further or deepening segmentation of risk aversion? So when we talk about risk aversion, risk off, you're looking for more selling or a deeper corrective movement in the likes of these assets. Now again, we've talked about the 2 to 3% rule in the likes of indices for dip opportunities. You then actually expect further selling, but for that we have to look at some of those prominent areas of interest being broken to initiate a deeper runoff in some of these risk orientated assets. So keep an eye on that. For the rest of the week, when we look at the calendar, obviously with the government shutdown, it's really more this week driven about by European data announcements. We do obviously have a RBNZ tonight into tomorrow morning. So 2 p.m. tonight, we're expecting another 25 basis point cut by the RBNZ to go to 2.75%. That is what's expected. German data tomorrow morning, industrial production at 7 a.m. Worth keeping an eye on that. But again, tomorrow we've got FOMC minutes, which is not going to be dictated around the government shutdown. Obviously, central bank being an independent organisation. We've got Lagarde on the wires. We've got FOMC minutes tomorrow as well. So quite a busy day for speakers. And then, of course, Thursday, the big one for me is Fed Chair Powell as he speaks on the wires at 1:30 on Thursday. And again, bringing in the narrative of what is coming in October. We are very, very confident we're going to see another 25 basis point cut in October. But with the government shutdown, is there going to be the possibility for a 50 basis point cut or an even deeper move? And if that is the case, that means that the Fed is leaning more dovish or more kind of supportive for market conditions. And if that actually happens, you might actually see the S&Ps, the NAS, the Dow, for example, take on a more aggressive risk profile. So worth keeping an eye on that on Thursday as well. But of course, we'll follow that on Thursday's US Open. And then, of course, Friday to round of the week, we've got Canadian data. Again, Michigan Consumer Sentiment Index, we have to be very, very tentative with US data prints because, of course, a lot of the bureaus are in shutdown because obviously they're not getting paid. So if they're not getting paid, they're not doing the work, which means none of the data prints are going to be released. So let's see how things progress over the next couple of days. Quite a lot to digest tonight, but important to actually take stock of where we are in the broader sense of things. And then, of course, moving then into tomorrow's US Open, and of course Thursdays as well for more updates in terms of that. As you see, the Macron news is pretty much dominating wires as we speak over the last kind of couple of days or so. Kind of picked up steam over the last day or two, but has really ramped up progressively today. So that, of course, is going to be worth watching. And then, of course, future pricing, we're watching the markets very closely in the back end for material effects. So that's where we're going to round off tonight. We will be back tomorrow for US Open at 2:20, and of course I will be following it up as well on Thursday for US Open as well. So as always, everyone, trade safe. Please be mindful of the downside. Be open-minded for those corrections, for those pullbacks, but also looking at those ladders to reaffirm more selling bias, as I said, if that is to emerge. And again, looking at the VIX volatility curve for steepening increases in risk aversion as well. All right, have a great night, everyone. Have a great evening, and we'll see you all tomorrow. Thank you.